Welcome everyone. Pitcher Partners and Macmahon Clark are delighted to host this compliance forum. It was actually around this time, I think last year, probably in July, that I presented to this same forum, and we were in lockdown here in Melbourne, and here we are again. So I hope everyone's doing okay, particularly in Sydney and here in Melbourne. But thanks for joining us. I'm Matt Moses, Special Counsel at Macmahon Clark in the funds team here, and I welcome you all. Looks like we have quite a few registrations today, about 430 registrations. So it's good to see that this forum's proving as popular as ever. As we continue to navigate through the challenges of COVID in the current times, unfortunately, the regulators haven't pressed pause. So there's a raft of new regulatory and compliance issues still ahead for the industry. To kick off today's webinar, I'll be looking at one of those. I'll explore in pretty brief terms the fundamentals of the new product design and distribution obligations. And then my colleague Elliot Stum, a partner in our funds team, will focus on changes to breach reporting for financial services licensees. Then the big guns come in. We've got Alexis Kokonos from Pitcher Partners will follow, and with a tax update, probably the more interesting stuff, analysing the latest developments for managed funds and key tax areas and issues. We've tried to keep the presentations as brief as possible so that we've hopefully got some time for questions towards the end. So you should see hopefully a Q&A box as part of the Zoom. We encourage you, if you want to, put some questions in, and subject to time at the end, we'll try and answer some of those. Just before I start, a few brief words about Pitcher Partners and Macmahon Clark. As a lot of you will already know, Pitcher Partners is a trusted advisor to middle market businesses across the country. Pitchers provide accounting, audit, and advisory services, drawing on a personal understanding and involvement of each client's affairs to provide tailored solutions. At Macmahon Clark, we're a boutique law firm focusing solely on the funds management and real estate transactions and industries, backed up by our litigation practice. We provide legal services across the life cycle of a real estate or funds management investment, from structuring to establishment to exit and disputes. So firstly, to my brief presentation on the design and distribution obligations. Just making sure I've got control of the slides. Okay. So the design and distribution obligations, which a lot of you will have heard about, what's it all about? I'm going to give a fairly quick high-level fly through or overview of this, because it's a whole topic in itself, particularly at the moment. But overall, what's the idea behind the design and distribution obligations? As many of you will know, the principle is really about having a suitable target market for each financial product, with the aim of getting the product into the hands of people within that target. At least that's the theory behind it. What I'm going to talk about today is the key legal obligations involved, briefly, quickly on ASIC's view of the process, then what's involved in implementing DDO in practice, and maybe, if we get to it, a couple of practical learnings over the last few months helping clients prepare for DDO. Now, what are the legal obligations involved in design and distribution obligations? There's really two streams of obligations. There's issuers, such as responsible entities and fund managers, and distributors. So firstly, for issuers, the key obligation is to make a target market determination, or TMD, for each of your funds. The next obligation is to take reasonable steps that will, or are reasonably likely to result in the distribution of that fund being consistent with that target market. Then there's an obligation on issuers to notify ASIC of significant dealings in relation to the fund. Now, you may ask, what's a significant dealing? Helpfully, that's not defined in the law, but we'll touch on it a bit later in brief. Finally, there's various obligations to keep records in relation to decisions made around the design and distribution obligations. Moving on to distributors, such as, of course, platforms and advisor groups and the like, their key obligation is to not distribute a fund unless there is a TMD in place for that fund. And then again, they've got a similar reasonable steps style obligation to issuers. So distributors must take reasonable steps at will or are reasonably likely to result in distribution of the fund being consistent with the target market as set out in the target market determination. There's an obligation also to notify the issuer of significant dealings in the fund, which again we'll talk about in brief soon. There's also information collection obligations on distributors to pass certain information back to the issuers. A lot of this whole new regime is actually about data collection, information collection by issuers and distributors, and also back to ASIC. Very quickly, ASIC's view of this whole DDO process is a very lengthy regulatory guide it put out. Again, probably a whole topic in itself, but the key is ASIC expects issuers to have an overall product governance framework or product governance arrangements in writing. So you really need a policy and supporting documents as an issuer, as a responsible entity, which document how you're going to design your funds, how you're going to ensure, how you're going to come up with a target market for your fund, and how you're going to ensure that you and distributors distribute the product only in accordance with that target market. ASIC also has a view that the target market is meant to come first in the whole process. So they actually expect you to design funds for a target, which we all know is a bit back to front, but that's a whole topic in itself. Moving on to the implementation steps for this whole process. And this is a big part of what we and clients have been working on over the past few months, and there's a lot of work continuing to go on moving up to early October. So which funds need to comply with DDO? Basically, if you've got a fund with a PDS in the market from 5 October, which is obviously coming up soon. So if your fund is open to investment, basically to retail investors at that time, you're going to need to comply, and you have to have a TMD in place for your fund. Then you've got to look at your distribution networks, which is an important part of all this. And again, there's a lot of work been going on here, and it's all part of the obligation to take reasonable steps, basically. So as a fund issuer, you've got to identify your distribution channels, whether it be direct distribution platforms, wealth managers, etc. And the key reason there is, as an issuer, you've got obligations to monitor and assess compliance by your distributors with the target market determination and ensuring reasonable steps are being taken. Now, there's then the question of what are reasonable steps, which again is a big topic, and there's been a bit of debate around this. The law isn't very prescriptive, but it depends on the fund and the circumstances. But as an example, to look at direct distribution by a fund manager direct to clients, one of the things ASIC says you should look at having, and a lot of people are working on this at the moment, is what are known as filtering questions at the application stage. So if someone's coming in through your website to apply to invest, for example, you may want to have certain filtering questions that are designed to get a feeling for whether that particular person is in or out of the target market. And as part of that, if you read what ASIC says, they expect you to also consider having what are called knockout questions. So, for example, if you had a complicated fund which was potentially higher up the risk curve, so to speak, maybe it trades CFDs or something along those lines. If you have an investor who says to you that they require preservation of their capital as part of their investment criteria, then it may well be that you choose to have a knockout question, so to speak, whereby if you find out that information as the issuer, that client may be prevented from investing. Just moving on, how do you identify the target class of investor, the target market for your fund. Overall, the question to ask is the fund likely to be consistent with the likely objectives, financial situation and needs of people within the target market? You may think that sounds a bit like personal financial advice, which it does. ASIC says just on that they consider that this process doesn't involve personal advice. You're really just looking at a target group of investors. So how do you work out the target markets to go in your TMD? It's really involves looking at certain criteria for the target, their knowledge, experience, risk tolerance, etc. And so, for example, the FSC has developed a TMD template. And if you have a look at that, it's a table and it sets out different investor attributes, such as, for example, the target investors' investment objectives, are they after capital growth, capital preservation, etc. And then it uses a traffic light style coloured criteria rating system that you then fill in for your fund. Moving on, I'll run through, I'll skip over some of this, but what does a TMD actually contain? Some of you have probably already seen the FSC template or other templates, but it contains a description of the class of investor in the target. You've also got to describe your distribution conditions. Now, what could they be? Again, very quickly, you might say in your distribution conditions for a particular product, if you've got a complicated fund, that perhaps you decide that it's only suitable to be distributed through a personal financial advice model. That's an example of a potential distribution conditional restriction. The TMD's then got to set out review triggers, so events and circumstances that would reasonably suggest the TMD is no longer appropriate. There's a number of examples of those. One example could be if you receive a significant number of complaints about performance of your product, you may decide that's a review trigger to work out whether the target market is still appropriate. And the TMD will also set out information about how distributors are meant to report to you, what they're meant to report, and things along those lines. Then the next major step is looking at your distribution arrangements, as I mentioned. Why have you got to do this? Because you've got to make sure that distributors are taking reasonable steps in relation to distribution within the target market, which really needs some sort of framework, preferably a contractual framework. And again, as I mentioned, distributors have to be agree to provide certain information back to you as a product issuer. As I mentioned, you're meant to have a DDO policy, a formal DDO framework and policy, and we're working with clients at the moment on getting those in place before the 5th of October. And that's, your policy's got to cover the stages of a fund's life cycle, the term ASIC likes to use. So design of a product, how you're going to distribute, and then monitor and review compliance with the TMD. Moving on to, I'll just skip to step 9 because it's an important thing. You may ask, do we need to update our PDS? There's nothing specific in the law that says you have to update the PDS, but we consider there will need to be some slight updates to current PDSs in relation to things like at least including a reference to the existence of the TMD. You might need to update privacy consent wording because you'll be collecting potentially, excuse me, additional information from investors about whether they may be in the target market in relation to which you'll need their consent and a few other things. But we don't think that there'll be wholesale changes to PDS as a result. Very briefly, advertising material is now going to have to make reference to TMDs from October, and you may need to start reviewing other policies as well, such as training, etc. Step 12, I won't talk about in detail, but as I mentioned, there'll be ongoing review and monitoring obligations on product issuers. For example, you'll need to have controls and processes to identify review triggers and significant dealing. So what is a significant dealing? As I mentioned, it's not defined, but an example could be if you happen to receive a bunch of applications from the one advisor group that are clearly outside your target market, that may be a significant dealing. And under the law, I should mention that if there's a review trigger for your TMD, if your TMD is being reviewed, you're actually meant to stop distribution of your fund until that's finished. Running out of time here, so I'll just get to the last slide. What are some of the practical lessons and learnings from helping clients prepare for TMDs, correct, but also for DDO over the last few months? One of the main things, which is probably no surprise, which a lot of you will know, is that the investment platforms have been largely driving the format of TMDs and distribution conditions, given they're a large part of the distribution network. So, for example, we're hearing that investors who use platforms without an advisor, or which are often referred to apparently as orphan clients, platforms may prevent those types of direct investors from investing in products because it may be too difficult for platforms at the moment to make sure that those investors are within the target market. Also, platforms seem to be a bit behind in relation to implementation and preparing for this, particularly in relation to their systems. So again, we're hearing that platforms are saying that at the moment, when October hits, they won't have facility to, for example, have filtering questions on their system for a fund, which links back to potentially only letting investors who have advisors come in to products. I've sort of run out of time, but there's other issues that keep coming up and will keep coming up over the next year as implementation of DDO starts. One very quickly, which is a whole discussion, is, for example, if you've got an investor in an existing product, and they want to apply for more units in the same fund, just say they want to apply for another $10,000 worth of units, what happens in relation to the target market? Do you have to consider whether they're still in the target market? It may seem ridiculous, but technically you probably do, although there's discussions going on over those sorts of practical issues at the moment. So again, a very high level, quick overview. I hope that helps, but it's a big area and one of particular interest at the moment. So now I'll pass on to my colleague, Elliot, to talk about developments in breach reporting.
Thanks a lot for that, Matt. So obviously the DDO is a really important overhaul that's coming into place for financial services providers. But an equally important one that you all need to be aware of is the new breach reporting regime that's coming into place. So for those of you that don't know me, as Matt said, I'm a partner in McMahon Clark's funds management team. And I particularly specialize in the regulation of fund and investment managers. So as I sort of mentioned, today I'll be talking to you about this new breach reporting regime that's coming in on the 1st of October. And what I'll be doing is kind of discussing the key features of that new regime and how it sort of differs from the current regime. And I'll also be giving you some tips on what we think you should be doing now to prepare for that new regime. So just before I kick into a brief overview of the current regime, there's a couple of preliminary things that I just wanted to mention. So under the current regime and the new regime, when it comes to significant breaches or breaches of a licensee's core obligations, it's not just breaches themselves, it's also likely breaches. But I'm only going to make reference in this talk to breaches, just so that I don't stumble over myself when I say breaches or likely breaches of certain obligations. So when I say breaches, just be mindful that when we're talking about your core obligations, it's also likely or anticipated breaches that are relevant. And just a second preliminary point, I'll be referring to this concept of core obligations quite a bit through my talk. So when I say core obligations, I'm really talking about the general obligations imposed on AFS licensees, as well as the obligation for retail licensees to have compensation arrangements in place. And the last sort of category of provisions that are relevant to this concept of core obligations are those relevant provisions of the financial services laws that are covered. And that includes the Financial Services and Managed Investment Scheme chapters of the Corporations Act. So just briefly on the current regime, I'll just talk about this because it necessarily sort of informs some of the background as to why the new regime has come into place and some of the key changes that are being made as part of the implementation of the new regime. So currently, licensees only have an obligation to report breaches that are significant. And if a breach has occurred that are considered to be significant, then a licensee is required to report that breach to ASIC as soon as possible, and in any case within 10 business days of the licensee becoming aware of a breach that could be significant. So one of the big concerns that have been raised around the current regime that's sort of being addressed in the new regime that's coming into place is this concept that significance and the significance test is sort of inherently subjective. So I guess when a licensee has identified a breach, it has to consider whether that breach is significant, and in doing so has to have regard to certain factors. And the subjective nature of the significance test has essentially resulted in quite a bit of inconsistency among the types of breaches that are being reported to ASIC. So that sort of concern has been raised for many, many years. And most recently, it was the subject of some recommendations in the final report that came out of the Royal Commission. And it's the implementation of those recommendations that has given rise to this new regime that's coming into place on the 1st of October. So the new regime is obviously really important for everyone to be across. There are a number of features that you need to be aware of, but in the interest of time today, I'm just going to run through a few of the key features that I think you all need to be particularly aware of. So one of those key changes that are being made as part of the implementation of this new regime is the concept of certain breaches being deemed to be significant. So under the current regime, there's an assessment of significance, but under the new regime, certain breaches are automatically deemed to be significant. So I'll talk about that one in particular. And another key feature that you should all be aware of, is the introduction of a whole bunch of new reportable situations. So it's not just significant breaches, but there are a few other things that if they happen, you'll need to report it to ASIC. And one of the other features that I think is also particularly important for licensees to appreciate is the imposition on ASIC of an obligation to publish report data annually. So just kicking off with this introduction of more reportable situations as part of the breach reporting regime. So there still is this concept of significant breaches, which is in place under the current regime and will continue. One of the key features of the new regime is this concept of deemed significance, and I'll talk about that one a bit later. In terms of other reportable situations that are caught by the new regime, one of them is this concept of gross negligence or serious fraud. So if in the provision of financial services, conduct engaged in that constitutes gross negligence or serious fraud, that's reportable to ASIC. Hopefully that new reportable situation won't cause much concern for financial services providers, unless of course you think gross negligence or fraud is not really a big deal, but I suspect you all do. One of the other new reportable situations that's coming in is this idea that you have to report to ASIC if you formed a reasonable belief that a reportable situation has arisen in relation to another unrelated licensee. So the sorts of reportable situations that you'd need to form a reasonable belief that have arisen in relation to another licensee are those around breaches of core obligations, gross negligence, and serious fraud. So on that point, just the key thing to note is the reasonable belief and the arising of the obligation to report is only relevant to other licensees that provide personal advice to retail clients. So that reportable situation is, it's really geared at financial planners and things like that. So one of the key ones that's now reportable is this concept of prolonged investigations. So if a licensee becomes aware of a breach and thinks that this might be a reportable situation and it starts investigating it, that will be reportable to ASIC, like the idea that there's this continuing investigation that's taking place. If that investigation goes over more, 30 days or more. So essentially, if you start an investigation, it continues for 30 days. You need to tell ASIC about that continuing investigation. And once you've sort of reported that there is a continuing investigation, once you've completed that investigation, you need to report that to ASIC as well. And that's the case even if the finding coming out of the investigation is that the breach doesn't constitute or doesn't trigger a reporting obligation. So if you find that an investigation or the relevant breach is not significant, you still need to go on and report that to ASIC. Now, as I mentioned, there's this pretty key change to the new regime that sort of is completely different to this current regime in place, and that's the concept of deemed significant breaches. So there are a number of breaches that, no matter how trivial they may be, are automatically deemed to be significant and are therefore reportable to ASIC. So a few of these wouldn't be that surprising, and they'd probably already amount and be assessed as a significant breach, such as if you engage in conduct that constitutes misleading or deceptive conduct. That's obviously something that may very well be significant anyway. There's also this concept of if there's been the commission of an imprisonable offence, that is deemed to be significant, and you need to tell ASIC about that. And in this context, the relevant offences, things that can result in imprisonment that might be for a period of 12 months or more, or in the case of offences that involve dishonesty, the period's 3 months or more. Another category of deemed significant breach is this idea of breaches that may result in or do result in material loss or damage to clients, and in that context includes a member or members of a scheme. So if there's a breach that could result in that sort of harm, it's automatically reportable to ASIC. One of the interesting categories of deemed significant breaches, which I'll talk about a bit more later, is this idea that if you breach a civil penalty provision, that's automatically reportable to ASIC. So there are a number of civil penalty provisions in the Act, and there have been regulations that have come out which will take effect once this new regime kicks in, that provides that certain civil penalty provisions, even if breached, are carved out of this deemed significance limb. And I guess another thing to note is just last week, ASIC published an instrument that also carved out the, not complying with the new internal dispute resolution system that's sort of coming in place. So I guess what we all need to be mindful of is, what a breach of a particular civil penalty provision will be significant, and the sorts of civil penalty provisions that might trigger that automatic reporting obligation may evolve and change over time. So in terms of some other key features, so as I mentioned, this is a pretty brief overview, but just to touch on a few others, the timeframe to report to ASIC has changed. So under the current regime, you've got to report within 10 business days of a breach occurring that could be significant. Under the new regime, that's been extended to 30 days, but the time that period starts has been moved forward a bit. So it sort of kicks off when you become aware of a breach and it could reasonably considered to give rise to a reportable situation. So that's an important one to be aware of. One of the big changes that I flagged earlier is this concept of ASIC being required to publish report data every year. So ASIC are going to publish on their website information about certain breach reports that it has received, and in doing so, we'll identify entities that have lodged those reports and the number of those reports as well. So what this will mean essentially is that if you're lodging breach reports with ASIC, your name may very well appear in a published document on ASIC's website. ASIC has said that they're going to qualify the sort of reports that they issue by saying that just because a whole bunch of reports have been submitted doesn't necessarily mean that there are huge instances of non-compliance by one licensee as opposed to another, but it might be because they've got really robust compliance systems that enables them to pick up breaches and report them. But I don't really think that's going to stop people from forming the view that a licensee that's got a whole bunch of breaches shown in that publication is not a licensee that has a great compliance culture. So that sort of informs the sorts of things that you should do in anticipation of this new regime coming in, which I'll talk to you about a bit more later. One of the other features is this idea that retail advisors, so people that provide personal advice to retail clients, also need to report to clients that are affected by that breach, but I just won't go through that in much detail now in the interest of time. So just quickly on what we think you should be doing now in anticipation of this new regime coming in. So as you can sort of appreciate, given this introduction of deemed breaches, you kind of need to adopt this new mindset and a new sort of approach to breaches. So I guess what often probably happens with licensees is that they identify a breach and think that, oh, it's not significant, it's not a big deal, we don't have to worry about reporting it. What you'll need to start turning your mind to is whether that breach, it relates to a civil penalty provision. And if it does, then it's automatically reportable. So something that you all really need to be aware of, and to sort of start forming that new mindset, it would be important to start training staff on this new regime and the significance of complying with the new regime in the context of the business. Just to sort of illustrate this idea that the insignificant may be significant, one of the civil penalty provisions in the Corporations Act are the duties that are imposed on responsible entities. So those duties, there's quite a few there, and a lot of them, I'm sure people would appreciate that a breach of them would be significant, but some of them are a bit, a breach of them may not necessarily be construed as being significant. And an example of that is this concept of a responsible entity having a duty to comply with the compliance plan for a scheme. So compliance plans obviously intended to include adequate measures to ensure that a responsible entity complies with the Corps Act as well as the Constitution of the scheme. So when people are doing compliance procedures, it'll be important to be mindful of the sorts of things that make their way in there, because any sort of trivial breach of any of those measures would, likely be a contravention of a civil penalty provision, which would give rise to this reporting obligation. So one of the things that might come out of this, the introduction of this new regime is, responsible entities, compliance committees having a look at, in preparing compliance procedures, whether they should continue to have really robust and prescriptive requirements in that document, or whether they should sort of be scaled back to meet that bare minimum concept of adequacy. So we're not too sure how that one's going to play out, but that's something that you all need to be aware of. So obviously this is a new regime, which means existing compliance procedures aren't necessarily going to be compliant with that. So they won't be if they haven't been updated yet, but if they have been, then they should very well be compliant before the 1st of October. So it's really important that all licensees have a look at their compliance procedures and make the necessary changes to make sure that it accommodates this new regime. Another thing you should be doing is testing the effectiveness of your compliance procedures, because this idea that, trivial breaches may be reportable, in order to mitigate the risk of you having to report things to ASIC, which may be published, you really want to have robust procedures that are good at preventing breaches to begin with. And given the new timing requirements set on reporting to ASIC, it's also important you've got procedures in place to readily identify those breaches so that you can comply with that reporting obligation. Just a final thing that I'll note briefly, the new regime has transitional provisions around it. So essentially, if you become aware of a breach before the 1st of October, you can deal with that breach under the current regime as opposed to the new regime. So one thing we think licensees should start doing is basically conducting a compliance audit so that they can pick up any potential breaches that may have been missed as part of their ongoing compliance, so that they identify that breach, become aware of that breach, and can therefore comply with the current regime as opposed to the new regime. So that's a really brief kind of overview of this new regime that's coming in. As I'm sure you can appreciate, there's a lot of detail in the new regime that you need to be across. So feel free to ask us any questions that you might have about that new regime. But that's it for me now. I'm just going to hand over to Alexis, who'll talk to you about the tax matters.
Thanks very much, Elliot. Welcome, everyone. My name is Alexis Kokinos, for those that don't know me. I'm a tax partner at Pitcher Partners, and I've been practicing for 26 years. I head up our funds management area at Pitcher Partners. Today, I'm going to be talking to just a few tax issues. One of them includes an accounting issue. And predominantly, obviously, I can't talk to all the issues that are happening with tax, and I can only talk to these very briefly in the 15 minutes that I'll be covering these items. For those that know me, I do talk very fast and jump through issues very quickly. So if there are questions or a follow-up, please feel free to send me an email or follow me up after this session. So I'll jump straight into the first item, which is on general purpose financial reports. And essentially, what's happening with respect to general purpose financial reports is that there's been a new accounting standard, AASB 2020-2, that has been introduced with effect from 1 July 2021, and it's changing all the accounting standards such that the application requirements, which previously only really applied where you had for-profit entities that were required to prepare financial statements in accordance with the accounting standards. That was the previous general requirement that applied on the accounting standards. Now, going from 1 July 2021, there's been an expansion to the application of accounting standards, and it will apply to those that are required by the constituting documents or other documents to prepare financial statements that comply with Australian accounting standards. So that's what's happened in terms of a change. Now, what does that mean for many of the funds? And generally speaking, for those that are required by legislation to prepare financial reports, probably doesn't mean much. So those registered schemes that already have to comply with the accounting standards, it means probably no real change. Where this does really impact those that are the unregistered managed investment schemes, where they do have other documents that may refer to the preparation of financial reports under the accounting standards. Now, it doesn't only refer to constituent documents, it refers to any other documents that may require preparation of financial reports. So for an unregistered managed investment scheme, probably the three most important documents that may require this are the Constitution, the Information Memorandum, and potentially loan documents that you may otherwise have with financial institutions or third-party financiers. And those documents may very clearly require you to prepare financial reports in accordance with the accounting standards. So prior to this standard, you may have had some leeway in terms of what you place in your financial reports. However, from 1 July 2021, you may have to apply the full extent of the accounting standards. Obviously, there are some reduced disclosures accounting standards. Obviously, 1060 may reduce some disclosures, but it may require you to apply the full accounting standards. Now, it doesn't apply, there is what I call a transitional provision, such that it only applies to constitutions or other documents created or amended after 1 July 2021. So a lot of entities may already be out of this. The key worry there is that it does apply to any amendments to documents that happen after 1 July 2021. And just to give you an example, if you have a banking document that refers to preparing financial reports under the accounting standards, and it does use those terms to say, and you change the LVR ratio under the loan document, so there's an update to the loan document, that amendment would be sufficient to bring that requirement into these rules. And then if you were to prepare financial reports to the bank, you would have to comply with all accounting standards when preparing those financial reports. A key thing, therefore, for funds to be looking at the moment trustees and fund managers is to review your documents, your constitution, your IM, and your loan documents to see what it does refer to. It refers to accounting standards in simple form in terms of preparing financial reports. You should be looking as to whether that can be changed. If you are creating a new trustee IM or other documents, again, look at whether you do need to refer to accounting standards or whether you can refer to accounting principles, or if you can have an exclusion such that the trustee can determine which accounting standards to comply with. It is quite important that you do address this pre-30 June 2022, or if you're doing half-yearly accounts, 31 December 2021. For legal firms that are in attendance, I would recommend that you have a look at your trust deeds. I think as a standard, a lot of trust deeds have a requirement to prepare financial reports in accordance with accounting standards and define them as being the accounting standards issued by the AASB. So just be mindful of that. You might want to look into that, and you might also flag that or highlight that with new funds that are being created. I'll jump to the next item, which is a tax issue. It's in respect of performance fees, and we've seen through the last 12 months that the markets have gone still quite well, even under COVID. And there have been some substantial performance fees that have been paid out over the last 12 months. One key issue is that a lot of people just assume that a deduction's available for performance fees. However, to obtain a deduction for any expenses, you need to have a nexus with that expense in earning income or an exit to your business. There is a specific provision that says where you incur an amount to earn a capital gain, that an amount isn't deductible, and thus the amount will effectively go to cost base. And the ATO have challenged a number of these types of classifications, either being deductible or whether it's gone to cost base. Just an example that I put forward there, you might have a fund that provides annual returns of 3% and a benchmark of 8%, and you'll pay a performance fee if you achieve over the benchmark rate of return. And therefore, there's a question: are you deriving that or paying that fee to derive income returns in the fund or for capital growth? And does it cause an issue under 51 AAA? The reason the ATO look at this issue is because there's a double benefit when you take a deduction performance fees. You get to deduct the performance fee against a net capital gain, not the gross capital gain. So if you have a look at the table that I've got there, you'll see that the performance fee that I've applied in this case provides a double benefit when it's being treated as a deductible performance fee as opposed to cost base in the example. If you don't get a deduction at all, obviously it can be a black hole cost if you can't get into cost base either. The reason that the ATO can challenge a performance fee from a cost base perspective is the cost base rules are very specific in terms of performance fees. They do require the cost to have a purpose of basically trying to maintain the value of an asset or increase the value of an asset. And implicitly, we know performance fees are there to do this. However, unfortunately, the IMs and IMAs are generally silent around the reason for the payment of a performance fee. We always recommend that there are self-serving comments in the IM and IMA that outlines the purpose in case this issue is challenged by the ATO. And I have had cases where the ATO have challenged both the deduction and cost-based treatment in the past. Finally, I'll just note that the Treasury didn't announce an amendment to remove the ability to take deductions against discount capital gains. Now, that was going to happen from 1 July 2020, however, it's been pushed forward to 3 months after the date of royal assent. So practically, the ATO don't like this issue and have been successful in proposing an amendment to ensure that you don't get performance fees against discount capital gains. It is something that you should be aware of for 30 June 2021. I know a lot of people have already signed off on their distribution calculations. However, if you do have substantial performance fees for this year, please be mindful of this issue. The third item I wanted to quickly touch on is this concept of late capital and late interest. What we're noticing recently is that this concept is being built into a lot of new funds that are being established. It's not a new concept. Global PE funds have had this in their funds for a long time, but we are seeing a growing interest in this for local Australian funds. Just if you haven't looked at this concept before or haven't come across it, effectively what it involves is you'll establish a fund, you'll issue units at the NAV at the starting point, and then investors may come in late and what you might charge the NAV or a unit price, and you might charge a catch-up interest component, and that's to compensate for you coming in, for the investors coming in late. The trustee typically then takes that late, what they call late interest amount, the compensation component, and distributes that to the initial investors to equalise them as a part of the establishment of the fund. Now, from a personal perspective, I note that a lot of these concepts are getting built into funds, and I believe not a lot are truly understanding the nature and treatment of late capital and late interest. So I thought I'd give a personal view as in terms of what or how the items may be treated and the tax implications for those items. Again, I can only cover this in a very high level, so happy to talk about this further after this session. So although these concepts are referred to as late interest, from a legal and from an ATO tax perspective, interest requires there to be finance provided, i.e. a loan provided. In this case, when the person comes in late to the fund, there is no loan to them. They're just paying an amount. In my personal view, I believe this is just a compensation or catch-up amount that adjusts the unit pricing for when you're coming in. So it's adjustment to your application price, even though you might describe this as something different in the documents. This is added to the assets of the fund and thus the corpus of the fund, and gets distributed to investors. So there is a cost base, or there's likely to be a cost base on your units, and there are treatments of the distribution back to the investors as to whether that's a reduction in cost base or a treatment of an assessable amount to the investors. So there is an implication definitely for the incoming and outgoing investor, but it raises other issues. So the fixed trust provisions, you need to be a fixed trust in order to carry forward your losses and to get franking credits out of the trust. If you're not a fixed trust, it basically can mean that you may lose your losses and you may lose franking credits. Now, to be a fixed trust, you do need to issue units at NAV, and having a late interest adjustment will breach that rule. The ATO have a practical compliance guideline 2016-16 that gives some different ways to calculate NAV, and they have got adjustments in that, but they do not cater for late interest. So including late interest means you won't be in a safe harbour and that you won't technically meet the fixed trust provisions. Now, that doesn't mean that you can't carry forward losses. There is another pattern of distribution alternative test that you can get access to. It requires you not to distribute any income or capital until you've used all your losses up, and the ATO give this exception on their website. However, unfortunately, under a late interest type clause, you will distribute the interest as soon as it comes into the fund, and thus you'll have a first distribution at that point in time, and it'll breach the pattern of distribution test. So again, it could result in all of your losses being from an ongoing basis from that date, failing the trust loss provisions. So there can be significant implications if you expect your fund to be in losses from the start to a later period in time. So that's all I'm going to talk about on late capital and late interest. Again, if you are looking at these clauses, please make sure you understand what those are, and you may in your tax section need to describe that for investors as well. In the interest of time, I'm going to jump to the very last item that I want to talk to today. Again, quite a topical issue that keeps coming up, and that's the treatment of the disposal of assets in funds and the capital versus revenue treatment in funds. And we're seeing a lot more ATO activity around this. ATO are picking up what is being disclosed in the AFR and other places and approaching funds in terms of their tax treatment on the sale of property. So it is one that comes up quite often and is easy for the ATO to access in terms of information. There is a different treatment in terms of whether it's capital or revenue and whether you can get the discount capital gain as to whether you're a small fund or a larger fund. For small funds, a lot of small funds can't access the capital account election. And so they effectively need to go to the common law in terms of determining whether it's on capital account. The ATO have a ruling already, it's TD 2011/21 in terms of their view on this. They provide a couple of examples, example 3 and 5, property funds and private equity funds. The ATO's view, basically, it's almost impossible to get on capital account, and they are likely to treat things on revenue account. They basically hold that if you incorporate the capital growth in your IR and effectively have a short-term fund, 5 years, that it is very difficult to argue that it is on capital account. So it is a big watch out. Obviously, the term of the fund, what you disclose in the IM are absolutely critical things if you are not going to be a larger fund and don't get access to the MIC capital account election. On the larger funds, you may have access to what we call the MIT capital account election, so you can elect to treat all of your assets on capital account. I'll just highlight that a lot of funds accidentally don't make this election in the first year because they are small and they don't make it in that first year, and they go to look to make it in a later year when they are large. They actually are precluded from making it in the latter year. That's because the provisions say that if you are small in the first, in what we call the startup period, you're deemed to be large, and that you have to make that capital account election in that first year. So if you miss out on this, unfortunately, all assets other than property are treated on revenue account and deemed to be on revenue account. And we are finding that a lot of people are missing this issue when they're establishing their fund. Assuming that you get the capital account election correct, then equity funds are generally will be able to apply that safe harbour for most of their assets. The property funds, unfortunately, can't apply the safe harbour capital account election. They don't get deemed capital account treatment. What happens in a year of sale is it takes you back to meeting a whole lot of conditions, which basically requires you to meet a trading trust test. And what that provision requires you to do is to look at effectively whether you're holding a property for the primary purpose of sale. This exclusion is contained in section 102MC. So you do have to go back and look at why you bought the property, and was it for the primary purpose of rental, or was it for a different purpose? And if it's for the primary purpose of rental, you get through this test and you may get the capital account election. If you can't prove that the acquisition was for primary purpose of rental, you will likely fail this test. Failing this test can result in the loss of the capital account treatment, but also can treat the fund as a public trading trust, which means effectively it's deemed to be a company in that year, and the trustee will have to pay tax on the gain and distribute franked distributions. If you miss that issue, all distributions can be unfranked and you can get double taxation on top of this. So this is a very significant issue, and one the HO is now looking at more closely. So it is one that when you set up the fund, it is really important all the documentation, IM and other things are properly drawn up in terms of trying to ensure that the primary purpose of the fund is for rental purposes. The term of the fund is sufficiently long enough to meet the ATO's requirements, and that you don't have all sorts of different income coming into the fund as well. So with that said, those were the 4 items I wanted to talk about as an update. Obviously, there's a lot more tax issues that are happening at the moment, but I'll end my session there and open it up, I believe, back to Matt for questions.
Here we go. Sorry, just having a problem with my video, of course. Hopefully you can all hear me. Thanks, Alexis. We're just having a look to see what questions have come in. In my space, it would seem there's a very popular question. About 99% of the questions that have come through on DDO are the same question. So it's obviously one that's at the top of people's minds. And that question is, does DDO and the requirement to prepare a TMD apply to an unregistered wholesale fund, so for wholesale investors? The answer there is you only have to prepare a TMD if you're required to prepare a PDS for your fund. So that basically means it only applies to retail funds. So if you have to prepare a PDS for a fund, if you've got a PDS on issue, then yes, you're going to need a TMD. But for a wholesale fund with wholesale investors in it, you won't need to comply. The other question that I can see there is, does it apply? Do you need a TMD for risk insurance products? The answer there is yes. So it's a fairly simple answer there. Just seeing if any other questions have come through. Again, same question in relation to wholesale funds. I don't know, Alexis, if there's any tax questions that have come through. There's none I can see at this point.
There was just a general question around the financial reporting for AFS licenses on the general purpose framework, and reference to the FF70, the P&L that needs to be lodged with ASIC. Generally, the only change that's happened effectively is that if the legislation requires you to prepare in accordance with the accounting standards, or a document requires you to prepare it in accordance with accounting standards, then absolutely that then has to be general purpose. If FS 70 and FS 71 does not require that to be in accordance with accounting standards, there should be no change to that framework. So it comes down to what they reference to and what they require as preparation.
Okay, thanks. Another question's just come through as to whether you can get a copy of the slides and the recording. Yes, I understand we'll be sending around a link to those to all attendees in the next couple of days. So you'll definitely get those. I can't see any others that have come through. So it looks like that's it for questions. So on behalf of Cliff, Clayton, and the Compliance Committee Forum, I'd like to thank you for attending today. I hope it was useful. As I mentioned before, a link to the slides and presentation should be distributed in the next few days. For more information about anything that we've talked about, feel free to reach out to the speakers. Our contact information is available. And again, thanks for joining, and particularly to those in Sydney, I hope everyone's going okay. Thank you.